The biggest surprise of the week came from the Swiss National Bank. The Swiss cut the interest rate by 25 BP to 1.5% yesterday, in a surprise move, and became the first major central bank to cut rates. The SNB is expected to lower rates 2 more times this year, and the latter should lead to a gradual depreciation of the Swiss franc, help exporters to see the light at the end of the tunnel, and support the stock valuations. UBS observes that a 1% depreciation in the franc leads to around a 0.9% rise in Swiss stocks. The SMI jumped 0.73% yesterday. Now, if the Swiss could kick off the pivot party, it is because inflation in Switzerland has been easier to fight for the SNB thanks to the traditionally strong franc. The Swiss inflation fell to 1.2% in February. But the fact the Swiss jumped into the water raised the expectation that the others would join soon. How soon? If all goes well and inflation remains under control, the Fed and the ECB are also expected to cut in June. In the UK, 2 Bank of England hawks dropped their rate hike vote. As such, no one voted to hike the rates in Britain yesterday. 8 MPC members voted to stay pat and 1 voted to cut. Votes in favor of cut are yet to rise, but the bow also gives signs of turning its back to policy tightening. The Fed, whose underlying economy doesn't necessarily need a rate cut, sounds dovish, and the ECB, whose underlying economies need a rate cut, remains relatively hawkish. The data tells one story, the policymakers tell another, and the prices move unpredictably.